Every global reserve currency begins its life not as a purely financial phenomenon, but as the monetary expression of a dominant empire. The first stage of the cycle is about power projection, the ability of one nation to control sea lanes, protect and sometimes coerce international trade, and impose rules that everyone else has to live with. Money comes later. First comes the capacity to shape the world's physical and political landscape. Historically, this pattern is easy to see. In the 15th and 16th centuries, Portugal built one of the first truly global naval networks. Using advanced ship designs and navigational techniques, it established fortified trading posts from the coast of Africa to India and Southeast Asia. This military and maritime superiority allowed Portuguese coins and credit to circulate far beyond its borders because merchants had to interact with Portuguese-controlled ports to access key goods and routes. The Netherlands followed a similar path in the 17th century. The Dutch didn't just have strong ships, institutionalized their power through the Dutch East India Company (VOC), a kind of early multinational corporation with its own armed forces. Dutch fleets escorted merchant convoys, suppressed piracy, and enforced trade monopolies. Over time, the Dutch guilder became widely accepted as a medium of exchange and a unit of account in European trade, precisely because Dutch power underpinned the safety and reliability of commercial flows. In the 19th century, Britain raised this model to a new level. The Royal Navy became so dominant that it was often said Britain had more naval power than the next several nations combined. The British Empire controlled critical choke points like the Suez Canal and strategic colonies around the globe. This maritime network gave London enormous leverage over international trade, and the pound sterling naturally became the leading reserve currency. If you wanted access to global markets, British rules and British money were the standard. In the 20th century, the United States took over this role. After World War II, the U.S. Navy effectively guaranteed freedom of navigation across the world's oceans. American carrier groups and bases near critical straits gave Washington tremendous influence over global shipping and energy routes. This security umbrella allowed international trade to flourish under a relatively predictable set of rules. And the U.S. dollar emerged as the central medium for pricing, saving, and settling cross-border transactions. The key insight of Stage 1 is that money follows power. Reserve currency does not become dominant because of abstract trust alone. It becomes dominant because the issuing nation can enforce contracts, secure trade routes, and provide a kind of global public good in the form of security and predictability. Merchants and investors choose the currency that sits behind the strongest navy, the most powerful military alliance, and the most robust legal infrastructure. However, this military dominance is expensive. Maintaining fleets, bases, and global alliances requires enormous and ongoing spending. In Stage 1, that spending can be supported by strong economic fundamentals and a growing tax base. But as the cycle advances, the very same machinery of power that gave birth to the reserve currency can contribute to its eventual strain and overextension. Thus, Stage 1 sets the foundation. A single power rises above the rest, controls key trade arteries, and imposes a framework that the world largely accepts. Its currency begins to spread because its power makes trade through its system safer and more profitable than the alternatives. That is the first step in the seven-stage journey of every global reserve currency. Trade surplus and massive wealth accumulation. Once military and geopolitical dominance are established, the empire naturally proceeds to the second stage, a powerful, export-driven economy that accumulates wealth at an extraordinary pace. This is the phase in which the country's productive capacity is unmatched. Its industries are globally competitive, and the world eagerly buys its goods and services. As foreign nations pay for these imports, the empire's currency and assets increasingly pile up in the hands of others. Portugal experienced this in a rudimentary way through its control of the spice trade, precious metals, and strategic ports. The wealth that flowed back to Lisbon from Asia, Africa, and the Americas was enormous compared with the size of the Portuguese population and economy. The country became rich because it controlled access to valuable goods and trade routes. The Dutch version of this surplus phase was even clearer. In the 17th century, Amsterdam was a commercial and financial hub of Europe. Dutch merchants dominated trade in grain, textiles, spices, and many other commodities. The guilder became not only a convenient medium of exchange, but also a trusted store of value. The Netherlands developed advanced financial markets, including the first modern stock exchange and sophisticated systems of credit. Foreigners held Dutch assets because Dutch trade surpluses and prudent finance created confidence in the long-term strength of the currency. Britain's trade surplus era, particularly in the 19th century, was marked by the Industrial Revolution. British factories produced textiles, machinery, and manufactured goods that were shipped worldwide. The rest of the world sent Britain raw materials and gold in exchange. London became the clearinghouse of global finance, and the pound was used for invoicing, settlement, and reserves. British capital financed railways, mines, and infrastructure from South America to India, reinforcing the pound's role as the global benchmark. In the United States, the surplus phase peaked in the decades after World War II. American factories were intact, while much of Europe and Asia lay in ruins. The U.S. became the primary supplier of industrial goods, machinery, and technology. It also exported capital, lending to allies and participating in the reconstruction of Western Europe and Japan. Under the Bretton Woods system, foreign central banks accumulated dollars, which they could, in theory, convert to gold at a fixed price. This gave the dollar a unique aura of solidity. It was not just paper. It was a claim, ultimately, on America's gold and productive capacity. During Stage 2, the dominant power's current account is typically in surplus. It exports more than it imports, pulls in gold or foreign reserves, and builds up a growing stock of wealth. Its currency becomes widely held and sought after because it is backed by real productive power and tangible assets. The world wants to save in that currency because it corresponds to the most advanced and dynamic economy on Earth. But this phase also plants the seeds of future imbalances. As wealth accumulates, the empire's financial sector grows more powerful. Asset prices rise, capital becomes abundant, and domestic populations grow used to rising living standards. The country's elites start to shift from a culture of production and thrift toward a culture more focused on finance, services, and consumption. That transition is gradual, but it sets the stage for the next pivot in the cycle. In short, Stage 2 is a golden age of surplus, savings, and global prestige. The reserve currency is not yet being abused. It is being earned through hard work, innovation, and superior exports. However, sustained success eventually changes behavior, and the system begins to slide into the next stage where formal recognition and institutionalization of the reserve currency role takes center stage. In Stage 3, the dominant nation's currency is no longer just widely used in practice. It becomes officially recognized and institutionalized as the world's primary reserve currency. Treaties, international organizations, and formal agreements codify what was previously an economic reality. The empire's financial system becomes the central spine of global trade and capital flows. For Britain, this phase emerged during the 19th century as London took on the role of global banker. Central banks and commercial institutions around the world held sterling reserves. Many international contracts were denominated in pounds, and British government bonds were seen as nearly risk-free. The Bank of England's policies had global repercussions, and the City of London became the place where international disputes were settled and financial deals were structured. The United States entered this stage in a dramatic way with the Bretton Woods Conference in 1944. Delegates from dozens of nations agreed to establish a new international monetary system in which the U.S. dollar would be the anchor. Currencies were pegged to the dollar, and the dollar itself was pegged to gold at a fixed rate. This effectively crowned the dollar as the central pillar of the post-war financial order. The International Monetary Fund, IMF, and the World Bank were created, and many of their operations revolved around U.S. financial leadership. At this stage, foreign central banks and sovereign wealth funds hold large quantities of the reserve currency. International commodities, such as oil, metals, and agricultural products, are priced in that currency. Global trade invoices, cross-border loans, and financial contracts are predominantly denominated in it. The country's treasury market becomes the de facto safe haven, a place where global savings flow during times of crisis. However, Stage 3 also introduces a deep structural tension, often called the Trifon dilemma. For the world to have enough reserve currency to use in trade and hold in reserves, the issuing country must supply that currency to the rest of the world. This generally means running trade or financial deficits, sending its money abroad in the form of investments, loans, or purchases. But the more it does this, the more it risks undermining the long-term confidence in its own currency. The empire now faces a paradox. To serve the world, it must export its money, but in doing so, it gradually weakens the very foundation of its financial position. In the moment, this may not feel like a problem. On the contrary, it feels like a privilege. The country can finance foreign wars, overseas military bases, and ambitious domestic programs by borrowing in its own currency. Foreigners willingly buy its bonds because they need its currency anyway. The line between privilege and overextension becomes blurry. During Stage 3, the reserve currency enjoys maximum global confidence. It appears unchallenged and indispensable. Financial markets in the leading nation deepen and become more sophisticated. New instruments are invented, capital flows freely, and global trade expands under the umbrella of this monetary order. Most observers, living in such a system, assume it will last indefinitely. Yet behind the scenes, imbalances are quietly building. The issuing country begins to rely on its special status to finance deficits, and its domestic economy slowly shifts away from production toward consumption and debt. The system remains stable for a time. The next phase of the cycle, reliance on deficits and living beyond means, inevitably arrives. Stage 4 is where the character of the system begins to change in a visible way. The empire that once ran trade surpluses and accumulated wealth transitions into a net consumer of the world's output. It maintains its high standard of living not only through productivity, but increasingly through borrowing and deficit spending, aided by its reserve currency status. In earlier stages, the dominant nation exported goods and imported gold or foreign assets. Now, the pattern reverses. It imports goods and exports paper claims, its currency and debt securities. Because the rest of the world still sees those paper claims as safe and valuable, they accept this arrangement willingly. Manufacturers in other countries are happy to ship physical goods in exchange for promises of future payment in the reserve currency. For citizens of the empire, this feels like an extraordinary blessing. Shelves are full of cheap imported products. Energy and raw materials can be paid for with the home currency, which the government and central bank can create at will. The financial sector grows even larger, facilitating a constant flow of credit for housing, consumption, and speculation. Asset prices rise, reinforcing the sense of prosperity. Government behavior shifts as well. Politicians discover they can promise more benefits and spend beyond tax revenues without facing immediate constraints. Large budget deficits become the norm rather than the exception. Major programs from social welfare to military expansion are financed by issuing debt that global investors are eager to buy. Since that debt is considered the safest collateral in the world, at the same time, the real economy starts to erode. High wages and a strong currency make domestic manufacturing less competitive. Companies move production abroad to take advantage of lower labor costs. The country becomes increasingly service-oriented and financially focused. While innovation and high-tech industries may remain strong, the broad base of industrial production shrinks relative to the rest of the world. This combination consumption, financed by debt, supported by reserve currency privileges, the defining feature of Stage 4. The empire is living above its means. But the bill is not yet due. Foreign nations continue to accumulate its bonds as reserves. The currency is still widely trusted and the financial markets are still deep and liquid. For many citizens and policymakers, there is no obvious reason to worry, yet the structure of the system is now fragile. Debt levels rise faster than underlying productive capacity. The political system becomes accustomed to easy money and reluctant to impose discipline. Any attempt to seriously cut deficits or reduce military commitments meets strong resistance domestically. The path of least resistance is to keep borrowing and hope that growth, innovation, or exceptionalism will justify it. Stage 4 is deceptive because it combines visible prosperity with invisible decay. On the surface, everything looks stable. High consumption, prestige assets, strong currency. Underneath, the reliance on deficits and debt grows, setting the stage for the next step in the cycle: explicit monetary debasement and directed money creation to support an overextended system. Stage 5 is where the story of every reserve currency becomes most familiar to modern observers. The era of monetary debasement. In earlier centuries, this often meant literally reducing the amount of gold or silver in coins, mixing in cheaper metals while preserving the same face value. In today's fiat systems, it takes the form of low interest rates, large-scale asset purchases, and the rapid expansion of the central bank's balance sheet. By the time Stage 5 arrives, the empire is deeply reliant on debt-fueled spending. Government deficits are large and structural rather than cyclical. The financial system is highly leveraged, and the economy has grown accustomed to cheap credit. When a crisis hits, whether a banking panic, a recession, or a geopolitical shock, the political pressure to do something becomes overwhelming. The easiest path is to create more money. Central banks in this phase often adopt extraordinary measures. They slash interest rates to zero or even below zero. They purchase government bonds and other assets in large quantities, injecting newly created base money into the financial system. These policies are presented as temporary and necessary to stabilize markets and support employment. In the short run, they can indeed prevent collapses and restore confidence. However, the long-term effect is to blur the line between money and debt. When the central bank buys massive amounts of government bonds with newly created reserves, it effectively transforms those bonds into money-like instruments. The government finds it easier to finance deficits because it knows the central bank stands ready to absorb its debt. Market discipline is weakened. Debt levels rise further, knowing that monetary tools can always be deployed to smooth over stress. Asset prices typically surge during these periods. Stocks, real estate, and other financial assets benefit from low discount rates and abundant liquidity. Those who own assets feel richer, but for ordinary households, the picture is more complex. Wage growth often lags behind asset inflation, and the cost of living rises over time. Savers who hold cash or low-yield bonds see their purchasing power eroded. In some cases, official consumer price inflation remains moderate for a while, especially if globalization and technology keep certain goods cheap. This can create the illusion that money printing is costless, yet the underlying structure of claims versus real resources becomes more unbalanced. Eventually, inflationary pressures tend to surface more forcefully, particularly after supply shocks, wars, or prolonged periods of ultra-loose policy. Stage 5 does not instantly destroy a reserve currency. The system can remain functional for years or even decades, while debasement proceeds gradually. But each round of crisis response printing chips away at faith in the long-term integrity of the currency. Foreign central banks begin to ask whether holding so many claims on a highly indebted money-printing state is prudent. Domestic citizens increasingly turn to real assets as protection. Thus, Stage 5 is the phase of slow erosion plus episodic shocks. Debt and money creation rise together. Political incentives favor short-term fixes over long-term discipline. The currency still benefits from inertia and network effects, but confidence is no longer absolute. The conditions are now in place for Stage 6, where the loss of trust becomes more explicit and alternatives begin to gain ground. Stage 6 is the turning point where the world's relationship with the reserve currency begins to change in a noticeable way. After years of growing debt and repeated monetary interventions, both foreign and domestic holders start to question the long-term reliability of the currency as a store of value. The process is usually gradual rather than explosive, but the direction is clear. Confidence is eroding. The first signs often show up in the behavior of central banks and sovereign institutions. Countries that previously concentrated most of their reserves in the dominant currency begin to diversify. They increase their holdings of other major currencies, such as those of large trading partners, and they allocate more to gold or other non-liability assets. Official statements may still affirm the importance of the incumbent currency, but their portfolios tell a more cautious story. At the same time, bilateral and regional trade arrangements increasingly bypass the reserve currency. Nations sign agreements to settle trade in their own currencies or in third-party units. Energy exporters may begin to accept multiple currencies for their commodities. Development banks and regional blocs experiment with alternative payment systems that reduce dependence on the traditional financial plumbing dominated by the empire. Financial innovations can accelerate this process. New payment technologies, digital currencies, or regional settlement mechanisms offer practical ways to transact without always rooting through the old system. While these tools do not immediately dethrone the reserve currency, they chip away at its monopoly position. Each incremental shift makes it slightly easier for actors to imagine a world where the incumbent is less central. Investor psychology also evolves during Stage 6. Large asset managers and institutional investors who once took the reserve currency's dominance for granted begin to treat it like any other investment, something to be evaluated on fundamentals rather than assumed to be risk-free. They look at debt levels, political instability, and long-term growth prospects, and they adjust their portfolios accordingly. Flows that once reflexively moved into the empire's bonds in times of stress now diversify among multiple havens. Domestic sentiment can become more polarized. Some citizens still see the currency as an anchor of national identity and global prestige. Others, especially younger generations who have lived through crises and rapid money creation, are more skeptical. They may favor real assets, foreign currencies, or alternative stores of value, feeling that the traditional system does not protect their purchasing power. Importantly, Stage 6 is not yet outright collapse. The reserve currency remains widely used, especially in trade invoicing and financial contracts. Its deep markets and legal infrastructure still make it attractive for many purposes. But the trend is no longer one of increasing dominance. It is one of gradual dilution. As more alternatives become viable, the cost of staying fully concentrated in the old system appears higher. Each conflict reinforces the lesson that dependence on a single dominant currency is a strategic vulnerability. In summary, Stage 6 is the era where the world quietly, then more openly, begins to hedge against the reserve currency's future. Confidence erodes not through a single dramatic event, but through a series of decisions by many actors seeking safety, diversification, and strategic autonomy. Once this shift in mindset takes hold, moving fully back to the old status quo becomes very difficult. The final stage of the cycle is the transition to a new monetary order in which the old reserve currency loses its central role. This does not always mean a sudden or total collapse in a dramatic sense. More often it means a relegation from unquestioned global standard to one important currency among several. The process can be messy, involving crises, negotiations, and institutional redesigns. Historically, previous reserve currencies lost their status after a combination of financial strain, military overreach, and the rise of more dynamic competitors. Portugal ceded influence to Spain and later to the Dutch. The Dutch guilder gave way to the British pound as the British Empire. Industrialized and expanded, the pound eventually surrendered its primacy to the US dollar amid the financial and geopolitical upheavals of the early 20th century and the two world wars. In each case, the shift was not just about which money people preferred. It was about which nation could provide the most reliable combination of military security, economic dynamism, legal stability, and financial depth. As one empire weakened and another grew stronger, trade networks, capital flows, and institutional arrangements gradually realigned. The old reserve currency remained in use for many years, but its share of global reserves, trade invoicing, and financial contracts declined, while the newcomer's share rose. In the modern context, Stage 7 could take various forms. One possibility is the emergence of a new singular hegemon whose currency replaces the old one as the dominant reserve asset. Another is a multipolar system, where several currencies backed by large economic blocs or regional alliances share the role previously held by a single currency. International institutions might formalize a basket of currencies or synthetic units as official reserves, diluting the dominance of any one nation. For the country losing reserve status, the consequences are profound. It can no longer finance large deficits as easily by issuing its own currency to foreigners. Borrowing costs tend to rise as investors demand higher compensation for perceived risk. Domestic living standards may fall relative to the peak years, especially if the country relied heavily on imports financed by debt. Political tensions often increase as different groups seek to assign blame and protect their interests. At the same time, losing reserve status does not necessarily doom a currency to worthlessness. The pound sterling, for example, remained a major, relatively stable currency even after the dollar took over as the primary reserve. The key change is not that the currency disappears, but that the extraordinary privilege disappears. The country must once again live closer to its real productive means, without the ability to effortlessly export its paper to pay for imports and military commitments.
Ow.
Globally, the transition can be disruptive. Financial contracts, trade relationships, and institutional rules must adapt. Some debts may be restructured, and some institutions may be reformed or replaced. Periods of volatility and crisis are common as markets adjust to the new equilibrium. Eventually, however, a new order settles in, with a different configuration of currencies and powers, and a new cycle begins. From a long-term perspective, Stage 7 is both an end and a beginning. It marks the conclusion of one empire, its monetary dominance, and the start of another arrangement, or centered on a new hegemon or spread across multiple poles. For individuals and nations alike, understanding this cycle is essential for navigating the turbulence that often accompanies such transitions, and for preparing for the realities of a world in which yesterday's risk-free asset is no longer treated as such.